What would happen if you put your money in the stock market for 100 years? Sounds crazy, right? I mean, you're not going to be here to enjoy it. Maybe your kids, grandkids, great-grandkids. Well, in today's video, we're going to dive in and see what happens if you put money in the stock market for 100 years.
Forever! Forever! Forever!
One eternity later.
Well, what's up, everyone? My name is AJ, and in today's video, we're going to be diving into the stock market. I've always heard the phrase that time in the market beats timing the market. So that got me thinking, what if we did put money in the stock market and left it there for 100 years? What would happen? What kind of returns would we see, and how much money could we actually make? But since we don't have a crystal ball to look into the future, I thought of the next best thing. Let's look at the past. So in today's video, we're going to be analyzing what an investment in the stock market from 100 years ago would be worth today. What kind of rate of return could we expect, and how does that percentage translate into actual dollars? And make sure you stick around, because we are going to be trying to use a crystal ball. We're going to be looking at the Oracle himself, Mr. Warren Buffett, often referred to as America's most famous investor, and see what his long-term outlook is of the stock market for the next 100 years. So let's get started. The first thing we need to do is understand what the stock market is. The stock market is where investors, i.e. you or I, can connect with each other, buy and sell investments off each other, often referred to as stocks, which are simply shares of ownership in a particular company. So what does that mean, and how does that break down? So what we're going to do, we're going to go to google.com, or Google search bar, and just type in Tesla stock so we could understand a little bit better. Right there we have our market summary. Tesla stock is trading for $850.45 per share. We're going to break it down a little bit better. I like to use Market Watch because they have the after hours, and this is this right here. They have the after hours trading price. So Tesla is trading for $851.87 per share. That is after hours. Tesla has a market cap of $800 billion currently. So we take the market cap and we divide that, the $800 billion, we divide that by our share price of $851, and then we get an outstanding share amount of 947 million shares. So what does that all mean? If you buy one share of Tesla, you are buying one slice of the Tesla pie. Now, we went over the numbers. Tesla's worth approximately $800 billion. That is its market cap. That's the total value of the company currently. You take that number, you divide it by the share price, you figure out how many shares are available to be publicly traded on the stock market. By buying one Tesla share, your money is tied to the performance of that particular company. However, the stock market's overall performance is tracked by looking at what's called index funds. The two most popular that you might have heard about are the S&P 500 and the Dow Jones Industrial Exchange. And in today's video, we'll be looking at the S&P 500. So let's briefly break that down. The S&P 500 is a stock market index fund that tracks 500 of the largest publicly traded companies and their performance. Thus, the S&P 500 is widely regarded to as the best gauge of how the stock market is performing. Think of it as a shopping cart. You take all these stocks from all these different companies and you put them into the shopping cart. You put them into that basket. And these stocks are tracked together to give the general public an idea if the stock market is doing well or if it's doing poorly. And if those 500 companies in the index fund are doing well, the S&P 500 goes up. And if they're not doing well, it's going to go down. Therefore, the S&P 500 has gotten bigger and done better and gone up in value. But how much bigger? How much better? And how much has it gone up in value? Well, historically, the S&P 500 has averaged a 10% rate of return. Some years are lower, but most years are much higher. But overall, the average has been 10% in the S&P 500 over the last 100 years. Let's go to S&P 500 from 1920. This is 90 years. We're looking for 100. So here we go, officialdata.org. S&P 500 returns since 1920. And we see here $100 in 1920. Assuming that you reinvested all dividends, and we'll go over dividends possibly in a future video, would be worth with a 10.34% year-over-year average rate of return would be worth about $2 million, which is insane. All right, here we go. Nerd Wallet. The historical average stock market return is 10%. We just discussed that. Some years will be lower and some years will be higher, but overall the average is 10%. That is the S&P 500 index, which again comprises about 500 of America's largest publicly traded companies and is considered the benchmark measure for annual returns. When investors say the market, they mean the S&P 500, and the long-term average is 10%. So what does that mean? $100 with that 10.34% year after year rate of return will get us to $2 million in today. What if we did $1,000? We'd be looking at $20,540.79, which is absurd. If someone put $1,000 into the stock market, the S&P 500 in 1920, again, assuming that they reinvested all their dividends, would be looking at $20 million today in that same account. So the question is, what if you took the dividends? What if you got that 10.34% year after year return without putting dividends? So you never put another dollar. So let's go over here and figure that out. So we're going to adjust some of these numbers. We'll go to $1,000 for current principal, 100 years in the stock market, 10% interest rate, and we're looking at $13 million, $780,000. Again, not too shabby for $1,000 investment that you don't touch, that you don't add any additions to. You'd be looking at $13 million. So then I thought, okay, 10% sounds pretty wild. $13 million for $1,000. What happens if we went to 15% annual rate of return? Would it make that much of a difference? So, yeah, it makes that much of a difference. We'd be looking at $174 million as our future value, which is just absurd. $1,000, if it sits for 100 years and is able to get 15% rate of return, you'd be looking at $1 billion. That's insane. And then the next thing that came to mind was, wait a minute, Mr. Warren Buffett here, who's returned an annual average return of 20.5%. There's a reason why he's America's most famous investor. He averages 20.5%. What would that get us? 20%, $1,000 invested, no additional money put in, 100 years to grow, $82 billion from a $1,000 investment. That's assuming you're able to match the Oracle himself, the most famous investor in American history, Mr. Warren Buffett. Good luck with that. You never know. And then the next thing I thought about, we know what 100 years gets us. We're trying to dive into the time in the market. So what if we did 50 years? Maybe something that we could be alive for. So what does 50 years, $1,000 investment get us with a 10%? And that's why time in the market beats it every time. 117,000 compared to 13 million. Go back to 50, 15% gets us $1,083,657. If we up that to 100 years, we're looking at 1 billion. There it is. There's the difference. 50 years at a 15% rate of return with $1,000 principal makes you a millionaire. 100 years, 15% rate of return with $1,000 principal makes you a billionaire. And for kicks, let's do the 50 years at 20. We're looking at $9 million, not too shabby. Versus $82 billion. Again, time in the market will always just win. Let your money grow. Do not touch it. The hardest thing sometimes to do is not to do anything. Put it in there and just let it sit, let it accumulate. And your grandchildren, or maybe your children, or maybe yourself will be a very, very rich person one day. And at the beginning of the video, I mentioned that we would discuss Warren Buffett, the Oracle's outlook for the next 100 years. So we'll use his crystal ball. Again, he has averaged 20.5% since he started trading in 1965.
I mean, the market's gone pretty much straight up.
The stock market in 100 years is a $1 million Dow. The Dow Jones is trading currently at 31,000. This is another index fund, which is comprised of the 30 large companies that each represent a different industry or the industry standard, and they're at 31,000. So Mr. Warren Buffett believes that in 100 years, we will have that at $1 million a share, up from $30,000 a share. And he's quoted as saying, which I thought was pretty interesting, he's quoted saying, "Let me be clear on one point. I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, well before either sentiment or the economy turns up. So if you wait for the robins, spring will be over. Over the long term, the stock market news will be good. In the 20th century, that is the 1900s, the United States endured 2 world wars and other traumatic and expensive military conflicts, the Depression, a dozen or so recessions and financial panics, oil shocks, a flu epidemic, and the resignation of a disgraced president. Yet, the Dow rose from 66 to 11,497. And he finishes off by saying, "Buy American. I am." And I think that says it all. Put your money in the stock market, and I think you'll be happy. And as always, leave a comment. Let me know what you think. If you like these type of videos, let me know, and I'll try to make more. Maybe we'll go over the stock terms or anything else to do with the stock market. Just leave a comment right there down below. We'll leave some links, all the sites that we visited. But that's our time. That's our video. Please subscribe, turn on the bell notifications, and if you like the video, do us a favor and like the video. And as always, remember, if there's a will, there's a way. Invest safe, invest smart, and invest in yourselves. Until next time, guys. Thanks.